Gold is at $5,030 an ounce right now. Not last month. Not in some analyst's price target for 2027. Today. This morning. Silver is above 81. These are not projections from a bull case that hasn't played out yet. This is the market, live as of this report. Most people's sense of what gold should cost is still anchored somewhere around 2,000. Maybe 2,400 if they've been paying attention. The distance between that anchor and where the price actually sits today, that gap is what this video is about. Not whether it goes higher, not whether it comes back down. The real question is what combination of forces moved it here and whether any of those forces are going away. Because if the answer is no, then the number on your screen isn't a surprise. It's a starting point. Let's start with the macro picture, because no single headline explains where we are. The US dollar index is sitting near 99.9 and has slipped about 0.5% in recent hours. That sounds like a small move. It isn't when you understand what it does. A softer dollar makes gold and silver mechanically cheaper for every buyer outside the United States. It expands the pool of demand without anything else changing. When the dollar weakens, metals don't need a new reason to go up. The old reasons just get cheaper to act on. Real interest rates, yields on government bonds after stripping out inflation, are sitting near 1.9% based on inflation-protected securities. That's not low. In 2020, real rates were deeply negative, and that environment was like rocket fuel for precious metals. This isn't that. But 1.9% is also not high enough to create the kind of sustained selling pressure that would push institutional money out of gold and into bonds. It's a neutral zone, which means the metals are holding at these levels without the tailwind they had 5 years ago. That matters. Inflation on the Consumer Price Index is around 2.4%, contained but not gone. And then there's the jobs number. February printed a net loss in payrolls, not a miss against expectations, an actual contraction. That shifts the pressure on the Federal Reserve in a specific direction, and we'll come back to that in a moment. The point right now is that none of these factors is individually dramatic, but they're all pointing the same way at the same time. That's the convergence. That's what's worth understanding. The single most underreported piece of this story doesn't live in the macro data. It lives in a warehouse report. COMEX registered silver stocks, the supply actually committed for delivery against futures contracts, are sitting near 79 million ounces. That is critically low by any historical measure. There's a category above that called eligible stocks, which is larger, but eligible means silver sitting in an approved vault that hasn't been tagged for delivery yet. The owner can pull it out. It's not yours until it's registered. The distinction matters more than most commentary acknowledges, but the warehouse number is a symptom of something bigger. The silver market is now in its 6th consecutive year where industrial demand exceeds new mine supply. Not a one-year anomaly. 6 years of structural deficit, compounding. Solar panel manufacturers consume silver at scale. A modern photovoltaic panel uses a meaningful amount of silver for its electrical contacts, and the build-out of solar infrastructure globally is not slowing down. Electric vehicles carry silver in their circuitry and charging systems. Consumer electronics haven't gone anywhere. There are efficiency improvements happening in some of these applications, yes, but they have not closed the gap between what the world consumes and what miners can produce. Here's a genuine question worth sitting with. Do you think a 6-year supply deficit is something this market has fully priced in? Because the price has moved substantially. But supply deficits that persist long enough eventually don't stay in the background. They become the story. The registered stock number at 79 million ounces suggests that point may be closer than the headline price implies. This is not a futures market anomaly. It's a physical market under stress. That's a different kind of pressure. Underneath the industrial demand picture, there's a second floor, a different kind. Central banks have been buying gold in sustained, substantial quantities through this cycle. Purchases moderated somewhat in early 2026, but the forward outlook points to hundreds of tons of additional buying expected through the rest of the year. These are not momentum trades. Central banks do not read a chart on a Monday morning and decide to add to their position. Reserve allocation decisions are made over years, ratified through institutional processes and executed quietly, which is exactly why they function as a floor rather than a catalyst. The de-dollarization dynamic belongs in this conversation. A number of countries have been actively working to reduce their exposure to dollar-denominated reserves, holding less in U.S. treasuries, settling more bilateral trade in other currencies, and diversifying into physical gold. This is not a fringe movement. It shows up in the official data from central banks across multiple continents. And it doesn't reverse because sentiment shifts or because a quarterly earnings report comes in soft. Think about what happens to that floor if central bank buying accelerates rather than holds steady. Not as a prediction, as a scenario to keep in mind. The floor isn't a ceiling. If sovereign demand rises, the asymmetry in the downside gets more pronounced. Dips get shorter, recoveries get faster. That's not an argument to act on any particular way. It's a structural feature of this market that changes how you should read a price pullback when it comes. Now for the variable that makes this week different from any other week this year. The Federal Open Market Committee is meeting right now. Jerome Powell and the committee have held rates steady through their recent decisions. No cuts, no hikes. A studied pause. And most of the market has treated that as the baseline expectation going forward. Then, the February jobs report printed a net loss. That number doesn't fit the baseline narrative. A labor market that loses jobs, not just adds fewer than expected, but loses them outright, is a labor market that changes the political and economic calculus for the Fed. The door to rate cuts later this year just opened wider. Not because Powell said so, because the data said so first. The complication is oil. Geopolitical tension in the Middle East, and specifically around Iranian oil and the shipping routes that flow through that region, has kept oil prices elevated. Elevated oil feeds into producer prices and eventually into consumer prices. That creates a real tension for the Fed. The jobs market is softening, which argues for easing. But inflation pressures from energy haven't fully resolved, which argues for holding. Powell doesn't get to pick one problem to solve. Here is how to hold the fork cleanly. If the Fed signals openness to future rate cuts, even in the language, even in tone, the dollar softens further, real yields come down, and the environment for gold and silver gets more supportive. If the Fed stays neutral or hawkish, the metals need to hold their current levels on their own fundamentals. And given everything in this report, the dollar, the supply deficit, the central bank buying, the industrial demand, there is an actual case that they can. The thesis doesn't depend on the Fed flinching. It's supported if it does. It doesn't collapse if it doesn't. Watch what Powell says about the jobs data. That's the tell. Let me bring this down to the chart level, because that's where the abstract becomes concrete. Gold has clear technical support near the $5,000 mark. Resistance sits higher, around the 5,240 area. Both of those levels are not arbitrary. They represent zones where volume has concentrated, where buyers have repeatedly stepped in or sellers have repeatedly lightened. The metal is currently trading above its key daily moving averages on the near-term timeframes. Volume profiles show buying interest concentrated right around current prices. This is not a thin, low-conviction breakout. The participation is there. Silver mirrors this structure. Support holds near $80. Resistance sits in the 82 to 83 range. The metal is up about 0.5% on the day and holding above the levels that matter. Options activity on COMEX gold and silver futures adds a layer. There's notable volume in call contracts, traders paying for the right to profit from a move higher. That's not a guarantee of direction, but it's information about where informed participants are placing asymmetric bets. Some put protection is also in place, which is normal and healthy. A market with no hedging is a market not paying attention. The confirmation that carries the most weight for me is the mining stocks. The GDX, which tracks gold mining equities, and the SIL, which covers silver miners. Both are higher today in line with the metals. Mining stocks tend to amplify moves in the underlying metals. When they confirm a rally rather than lag it, It tells you the move is not being quietly doubted by the people who have the most operational insight into this sector. That's worth noting. So, where do you think gold closes by the end of Q2? Put a number in the comments. Not because it determines anything, but because committing to a view sharpens the thinking. Here's the one thing I want to leave you with. When dollar weakness, a 6-year supply deficit, sustained central bank buying, geopolitical uncertainty, and a technically clean chart all arrive at the same moment, the question stops being, why are prices here? It becomes, what would have to break for them not to stay here? That is a different question. And right now, the honest answer is that the list is shorter than the list of things supporting them. Watch the Fed. Watch the dollar. Watch the registered silver stocks. The setup is clear. The timing is the only part nobody knows. One last thing. Everything in this video is for educational purposes only. None of it is financial advice, and none of it should be treated as a recommendation to buy or sell anything. Your money, your research, your decision. Full stop.